Your wrap of the biggest corporate and market news of the day in South Africa. I'm Erica van der Merwe. My guest host this evening, Nick Norman-Smith from Lentus Asset Management and Mark Ingham from Ingham Analytics. A busy day for company announcements, amongst them the pharmaceutical business Adcock telling the market that it has received further offers that following Bidvest having expressed interest in its business. And fresh South African economic data reflect production declines in manufacturing and mining in March. Should we be worried? We cover that with Nedbank Capital's Brigid Taylor. We start with a look at the day's market movement, starting with the global markets. Dow Jones up slightly. You can see the markets just standing back, absorbing the strong moves we've seen over the last few days. The FTSE slightly positive too. German market all reflecting similar increases on the day. Looking at the JSE and its sectors, you can see the Aussie down nearly 1/3%, but resources and financials up on the day. Moving across to commodities, the gold price at $1,471 per ounce, platinum at $1,515, and Brent crude oil $103.97 per barrel. And the currency moves also remains interesting. The rand at 8.97 to the dollar, 13.91 to the pound, and 11.77 to the euro. My guest host tonight, Nick Norman-Smith from Lentus Asset Management, Mark Ingham from Ingham Analytics. So, Mark, clearly you're part of the wage negotiation time that started with which union is it that you represent tonight?
The We Demand Union. Yes.
So tough time. But it's a perennial, it's an annual phenomenon that we move into the stage. So a difficult time. Corporates under pressure despite their cash balances. And what will happen this time, Nick?
Oh, it's a tough time to be negotiating as certainly as a miner, and seemingly across a number of industries we're seeing sort of negative economic data coming out. So. But they do have a government and unions that are certainly pro-labour, so I guess that does help you. We've seen that, with the interference that we're getting in AMPLAT's wage negotiations. So it's not quite a free market as such, but still, it's much more difficult to demand significant wages when the companies that employ you are batting to make any money at all.
Yes.
Nonsense. As workers are being oppressed by fascist management. And they earned 2,000% more than the average worker.
Which is true, Mark. So we know about the huge gaps, the disparity, the pay disparity between top management and workers. So that's another element, the social dynamics in South Africa.
Exactly. And our wage demands should be seen in that light too, to actually reduce that disparity, which is very disruptive to our members' lives.
So nevertheless difficult in the global context, and we bring in Brigid Taylor from Nedbank Capital. Brigid, as you'd all agree, interesting times in global financial markets, strong movement. We've got the influx, this wall of capital still coming, and promise of it continuing for a while.
Absolutely. I mean, if you look at all the developed nations, every single one of them implying some form of monetary policy easing, obviously with the most recent being the ECB now cutting interest rates, the BOJ on top of that. So there isn't really one sector where there isn't significant quantitative easing happening. The Japanese flows will only really start being evident probably towards the end of June. However, in the interim, we've seen obviously a lot of speculation on the back of that, driving yields globally to all-time lows. And you've seen other interest rate decisions coming out of the likes of Korea, out of Poland, out of India, etc., all looking for interest rate cuts, talking about things like hopefully pursuing some form of growth environment. And my argument is, if you look at what happened in Australia, the Bank of Australia cut interest rates on Tuesday, and really citing the fact that they want to promote some form of growth. However, they've cut interest rates 2% in the last 18 months, and they are no better off. They're not seeing any form of significant growth, and in fact, if anything, their current account continues to widen. So what is really the upside to doing that? And in fact, if you look at South Africa, a lot of pricing now going through, if you look at our FRA curve, looking for almost 75% chance of an interest rate cut within sort of the next 6 months. However, it's now even starting to price for the next decision, and almost 30% sitting as a 50 basis point cut. So the question that you have to ask yourself is, that interest rate cut, what will it really do in an environment where we have to continue to attract foreign flows because we have a massive current account deficit that continues to widen? We've got the twin deficits. If we see what happened in Australia with the cut, we see the currency weaken off quite significantly. So if that happens in South Africa, potentially we could have other inflationary implications, as well as the fact that it potentially places more burden on our trade account. So all all of those things speak to, for me, to a negative outcome rather than a positive outcome in terms of trying to curb interest rates in an environment where ultimately all of this wall of cash will continually drive yields lower anyway.
Well, Mark, perhaps you can come in, but also the point that Brigid made about Australia's monetary policy, I think, applies across the board. Policymakers implementing unusual measures and not necessarily seeing the results that they want. It's as though it's almost this vacuum, policy not gaining traction.
Well, here's the thing. Why don't we have interest rates at below zero, negative interest rate? You could actually do that. Strictly speaking, you could.
Sure, they're going to do it in Europe at some point.
And so that would arguably be more of a stimulant. If your argument is that going to 1% or 0.5% or 0.25% is a stimulant and it's not a stimulant, then counter to that is that going below zero may well be the necessary stimulant that the world needs.
No, I disagree with you. And the reason that I say that is, for me, the big concern is that, one, your consumers are running such extremely high debt-to-income ratio levels. That's the first issue. And they're concerned about their jobs because unemployment across the globe, and in South Africa specifically, is very high. Secondly, business is sitting on huge cash on their balance sheets, which indicates that they don't have impetus to do anything with it because there's not an environment that's conducive to investing in terms of long-term spend. So therefore, it doesn't speak to further employment, it doesn't speak to the growth that you require, and that is not going to be beneficial to those that have got that are sitting on cash piles. They're not wanting to borrow any more money, is my point. However, what it does do is it then, and as you've seen globally, is that money then starts to seek other homes. And if you look at South Africa in terms of investment vehicles, if you're looking at any of the auctions that are going through, anybody that's putting money or bonds into the market, the spreads have deteriorated markedly. Why? Because the demand is there for any form of pickup above JIBAR that you can receive, just because interest rates are at all-time lows.
Now, Nick, as a well-known value investor, what does one do in this environment? Because you've got this strange juxtapositioning, many stocks looking expensive, but then listening to Brigid, the prospects aren't great. So you might be able to somehow find something that's inexpensively priced, perhaps in the resources sector, but will it ultimately recover?
As soon as people are searching for yield, as Brigid mentioned, get very scared, because we saw people in Europe who searched for a bit of yield and put money into bank accounts in Cyprus. As soon as you're getting a yield that's far above, you generally are taking on a bit more risk. So I heard a quote the other day from a fund manager from quite a very well-respected large global institution saying that that absolute yield was overrated and it was all about relative yield, because buy anything because it's earning you more than government bonds. Now that sentiment is crazy for me. It's all about absolute yield. You can't eat relative performance. So there are some attractive...
But it doesn't exist. Does it?
Well, it does. There are a number of attractive equities. Certainly, in the global market, a number of developed market companies have been quite attractively priced. We have seen a big rally up, so they're not as many opportunities. But I mean, you can buy high-quality global businesses. A supermarket like Tesco in the UK on nearly single-digit price-to-earnings multiples. So those businesses are out there, but they're generally hated because they've got terrible growth prospects, or they've done poorly recently. They're in areas that people hate. So. Unfortunately, you've got to take the discomfort of doing that, and it is very uncomfortable when ShopRite's running and you're getting a slightly higher yield in South Africa. But just remember, if that does turn, you can get very badly hurt.
Brigid, do you have a view on asset classes? So it's clear what you've said about fixed income and cash and so on, but compare this now with equities.
With the equities, I agree with what he's saying. However, I think what's ultimately happening here, and the big risk that we run, is that any form of risk is being completely negated. So in the hunt for some form of return, what you're finding is interest rates have basically become extremely expensive to invest in bonds. So you're now looking for other investment vehicles. You're still getting a good return out of your equity classes. Why? Because business has cost cut. They've trimmed back their expenses. They're probably a little bit more lean and mean and better functioning. However, they don't have that upside profitability until the economy globally starts to pick up. However, where else do you put your money? So you're seeing equity markets continually rallying on the back of all this investment that is looking for a home, whether it's driving yields lower, driving equities higher, all of the risk around that. And as he mentioned earlier, the previous risks that we used to talk about it with regards to the like of Cyprus, or the company risks, are being negated purely in a hunt for something that has some relative value.
But if you're a central bank, you don't give two hoots about all that stuff. For the simple reason that with quantitative easing, the cheaper money is the better. Sure. And if necessary, you can sterilize it later. So the dynamics associated with not so much company balance sheets here, but country balance sheets explains the dichotomy between what would be a normalized level of interest rates, call it 4 or 5%, and where we are at the moment. And so long as we have these policies in place, this is exactly where we're going to stay. And companies I deal with need cash. They love cash on the balance sheet. Cash is now cool. You know, a few years ago, analysts were saying, "Oh, you've got to leverage. You know, you've got to optimize your capital structure." That's out the window now, and particularly with inventory management and the fact that you can actually get better stock turns. Where cash is king. I think we're in this position for a while. No companies that I deal with are out there signing checks, you know, wanting to spend terribly much. They are spending, and there are opportunities out there, but they are preserving cash and paying down debt wherever they can.
And I think they're also looking at Africa as the last frontier. I mean, if we look at what's happening in Cape Town at the moment, talking about things like they need to pick up the infrastructure spend in South Africa because South Africa is ideally positioned. However, any of the local companies that have invested in Africa, that's ultimately where their profitability is coming from. And that's something that's growing. You're seeing international companies coming through South Africa looking for stronger businesses that are already positioned in Africa that are showing some form of profitability to invest and to make some money out of those companies.
And that's where the problem comes in, because everyone is clamoring for this last bastion of growth. And what happens then? The prices get driven up. When the prices get driven up, as an investor, you've got much less opportunity of making money. Plus, you've got a lot more competition for your assets. So if everyone's going for this pile of assets in Africa, again, the chances of you overpaying for your
but there aren't many of them. And so that's why the canny ones, including some private equity and family offices, are doing greenfields. And that's not just agriculture.
No, sure.
You know, and with property particularly, you can't get commercial property like you can here. So you know, the real money will get made by greenfields, and that's where there's fertile ground, dare I say.
We'll have to end it there, Brigid. We haven't even touched on the manufacturing and mining production numbers, but both were down. Surprising analysts had expected expansion, so contracting 2.2%, that's manufacturing, mining down 3.5%, so it's worrying.
It speaks to South Africa's productivity, it speaks to the concerns we have around wage negotiations versus what we're seeing in terms of productivity. It also tells you that the global growth picture hasn't changed and the demand for South African goods remains benign. So for now, Rand remains around that 9 handle. It hasn't really moved despite the fact that we're seeing bonds rally and equity prices continue to do well. That's a concern because there is upside risk to the Rand.